which the market is keen to notice is how well the economy is recovering post the demonetization and the introduction of the GST. If investors can recollect, prior to demonetization, economy was growing pretty well, and then the demonetization led to some bit of slowdown in the economic growth. This was manifest in various growth indices coming down, index of industrial production, PMI, sales of goods. A lot of these indicators have started recovering at this point of time. So investors want to know how well their growth is coming back to pre-demonetization levels, as well as accelerating further. This is one primary trend which the market is looking at this point of time. The second key trend which the market is keen to see as well as gauge into the future is how well the benefits of softer rates, interest rates, is passed on to the corporate world, and how do they benefit from that. As the banks have moved to marginal cost-based lending system, we are seeing the first signs of banks passing on the benefits to the corporate borrowers, and the borrowing cost of companies are coming down. Coupled with better availability of funds, some amount of deleveraging trend has started happening, and some of the companies which were laden with excessive debt are beginning to sell assets, use cheaper cost of funds to deleverage. I think that is a secondary trend which is going to be of some importance to the market at this point of time. In the last 3 years, that is from fiscal 15 to fiscal 17, we have seen aggregate corporate earnings have been running below their expectations. For example, in the beginning of the year, market expectations would be around 15 to 20% earnings growth, but at the end of the year, we would end up with significantly lower numbers. In fiscal 15, we ended up with minus 5% earnings growth for the index. In fiscal 16, we ended up with 2% earnings growth. In fiscal 17, we ended up anywhere between 7 to 8% earnings growth, despite high expectations. But one important trend which we are seeing is the gap between expectations and reality is narrowing, which means slowly the aggregate earnings growth is falling in line with expectations, or expectations are falling in line with reality. Therefore, the scope of earnings disappointment has become less as we move in. In fiscal 18, the current expectations is that aggregate earnings growth will be anywhere between 15 to 17%. Our guess is that markets will deliver anywhere between 12 to 13% earnings growth comfortably, and that is a significant improvement from the earnings growth which we saw in the previous 3 years. And this will be the first year where the market aggregate earnings will be in double digit in a long while, which is the current expectations. As long as these expectations are met, we don't see a significant risk to the market's valuations, while on an earnings basis, market is trading at slightly above average valuations. The long period average is around 17 times forward earnings. Currently, market probably is trading at around 18 times forward earnings. But I'm not too worried about that valuation, because on other multiples like price to book, market cap to GDP, the current valuations are more or less in line with the average. So from a valuation perspective, market is slightly above average, but from an earnings growth perspective, we are seeing some acceleration in the current year onwards. We expect GST to have a far-reaching impact on the way businesses are done. In the near term, there is going to be some transient impact of GST on inflation. That is, prices of goods and services may notch up a little bit as system gets used to the implementation of new tax, and people are yet to get the benefit of input tax credit. But over a period of time, as the system, as the manufacturers and service providers get the benefits of input tax credit, we expect the impact of the transient impact of inflation will come down. Most important benefit of GST is for the organized part of the economy, where the manufacturers and service providers are already paying taxes. We expect many of them will become relatively more competitive versus unorganized markets and gain market share over a period of time. and that should accelerate the growth of organized market players. Most stock market listed companies being called organized players, we expect the earnings growth or the business growth for these companies to notch up a couple of percentage points because of the implementation of GST. The recommendation of what strategy to follow depends on the investor's risk appetite and the percentage of their assets in the market. Nevertheless, for entry-level investors, we recommend entering large cap oriented funds. In the case of Franklin Templeton, we recommend Franklin Templeton Blue Chip, Franklin Templeton Prima Plus. Even for seasoned investors who have been in the market for some time, we think the current valuations in the sub-segments of the market, I would recommend more balanced approach towards the market and avoid excessive concentration on the mid and small cap segments of the market, which means I would recommend them to focus more on diversified equity funds which have exposure to mid and small caps. In our stable, 3 funds qualify as diversified funds: Franklin India Flexi Cap, Franklin India Prima Plus, and Franklin High Growth Companies Fund. These offer the terms of large cap exposure and it's in the mid and small caps.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.